Welcome to the deep dive video update. And I always want to explain the idea behind this video. Deep dive in this context means the charts that I didn't really look at throughout the week, because sometimes we want to look at these charts. We can get some additional insight from these charts, even though I didn't include them in the other videos that I do. This is being prepared for Monday, October 21st. There's a thing called the SPX investing program. It's up, it's going, it's free until the end of 2024. Feel free to check that out. There are additional videos that I post there and additional courses that I teach that you might find helpful. There's a link in the description below this video that'll take you to that website, as well as a link to another video that talks about the program. Or if you have any questions, you are welcome to email me. The daily video is the real foundation of the analysis that I do. The video that you're seeing right now is a deep dive video. This is one of a series of weekly videos that I do, and that's meant to tie in to the analysis that I do each day. The first chart that we look at is a chart of the VIX, but what you see here is a 50-period moving average of the VIX. This is just to give us an idea of what is the general range of the VIX over a period of time. And as we've been going up, the VIX has been going down. And even though this line is going back up right now, we are still in a lower range for the VIX, which tends to be more positive for the market. We also keep an idea in mind of what direction is the VIX actually moving. And we measure this by using an RSI based on 9 periods. Right now, we're not really looking all that big when it comes to a movement in one direction or the other. So we're getting more of a neutral reading. We look for an extreme positive or negative reading here, and that's just not what's happening. We look at the VIX and then we do a ratio of the VIX to try to get some insight as what's happening here. Overall, this ratio is going up, but not really giving us any additional insight right now. We look at the VIX index, which measures the volatility of stocks, and the MOVE index, which measures the volatility of bonds. And we're really dropping down with this ratio as bonds had been under pressure. They're starting to come back down a little bit, and stocks have been going up. And so we're seeing this moving average tending to roll over. Now, the context of this can change somewhat. When this moving average is going down, stocks can go up. But there are other times when this is going up and stocks are going up. So we have to use other charts to really understand what's going on here. But this really dropping off just means, at least when we look at the ratio of the volatility of stocks to bonds, this stocks have really been going down lately, even though the VIX is giving us a very high reading at the current time. We look at the Ulcer Index, which also tries to measure fear. This is still below the moving average, so I haven't been including that chart. We are 21.71% above the previous all-time high that was set in early January 2022. And the market has really had a strong run after going through 2022 and then finally bottoming and going up from that point. Technical alerts are put out by stockcharts.com. Red is negative, blue or green is positive, and these are the alerts for the whole week. And typically, if we have an up day, we see a lot of blue or green. A down day, which was Tuesday, we see an awful lot of red. And then we see a mix along the way. But most of these ended up being positive as the Dow and the S&P have been setting new all-time highs. We also rank 5 different indexes based on a thing called technical scores. And this tries to remove the emotion from the chart, because that's what technical analysis is supposed to do, is just look at this chart and then objectively say, yes, we're going up, we're going down. Well, different people can look at the same chart and reach different conclusions. So what stockcharts.com has done is they've tried to just rank different technical indicators and then put them on a score of 0 to 100. The higher the score, the better looking that particular index. Now, you can apply this to a stock or to a sector. I apply this to different indexes. Coming in first place is the SPY. It's been doing better lately because it's consistent of consisted of more than 500 stocks. And some of these are not just all tech, where tech had been doing really good earlier in the year. Now it's lagging behind a bit. And so that's been dragging down some of the tech indexes that we follow, like the QQQs or the NASDAQ 100. And since this is spread out and there's more stocks in the S&P, it's actually been doing better. And even when we've seen some pressure under the S&P, the stocks inside of the S&P have also been maintaining their gains. But it's coming in first place at 83.2 this week. In second place are the QQQs, which have been showing some improvement at 78.5. In third place, believe it or not, are the small caps. They've been really lagging for a lot of 2024. Well, they're coming in third place at 75.3. And then the Dow, which just set an all-time high on Friday, it's not doing as well when you use this type of method to see where the chart is at as far as the strength of the chart. It's coming in at 73.9. And then in last place, even though they're setting all-time highs, are the mid caps coming in at 66. Then we look at a short-term chart. This is a rainbow going from 10 periods up to 50 periods. The big takeaway from this is the S&P is above all of these lines and the lines are going up. So this means the short-term trend is positive. Then we look at a 20-period simple moving average of the open, high, low, close. We're above all the lines in this mini rainbow and the lines are going up themselves. This also supports the idea that the short-term trend is comfortably positive currently. Intermediate term, another rainbow going from 50 periods up to 100 periods. Again, the lines are going up and the S&P is above all the lines, so the intermediate term trend is positive. I haven't been showing the 50-period moving average in the videos because we're kind of far away from it right now. We're mainly dealing with the 20-period moving averages, so this is looking quite positive. And the same thing is true with the 100-period moving average. Standard deviation coming back up to the moving average, but we haven't gone above it, so I haven't been showing this. This does not measure direction. This measures speed. How fast is the S&P going either up or down? When we're below the moving average, that means we're not moving as fast. The mass index, we're far away from this blue line or red dashed line, so there's no signal being generated in this chart. And the Pring bottom fissure is actually going down as the S&Ps have been going up. This is an indicator that we use when the market's really been coming down and we're looking to establish a bottom and then go up out of that. Well, we're not even close to that with this chart, so there's been no need to show this one. Then we also look at the distance from the 200 period simple moving average. We're a little bit over 10% above the 200-day moving average. And this is a measurement going back to the October 2023 lows, and we've been able to climb now up over 30% from those lows. The reason I have this marked in here, sometimes when we go up, like we did in the summer months, and then we pull back, we were measuring to see how far down are we going because the definition of a correction is 10% or more. And we got really close to that 10% level before we started seeing buyers coming back in. So we keep an eye on that if we start to decline. The Connors RSI is an oscillator, and we look for extreme positive or negative readings. We're not getting those right now. Anchored moving averages also, at least the way I implement them, they're more beneficial to us when the market's actually declining and we're going up and we're not near any of these anchored moving averages right now. So there's been no need to show this chart. The CMB composite is another oscillator. We are positive here. I only show this when we get above or below the black lines, and we're not there now. The Bollinger Bands, we did close outside. This was after Monday's session, and we tend to not stay there for very long. There's a number of different ways you can use Bollinger Bands. How I use this is when we close above or below the upper or lower band, because that generally means we've gone up or down too far too fast. Well, we did see that earlier in the week, and then we pulled back, and we're no longer extreme with this chart. Ichimoku cloud. This is really just a series of moving averages that are plotted and then shifted forward on the chart. There's some additional studies here. we have the blue line above the red line, which is positive, and we have the green line going up, which is positive, and prices above both of these, this green cloud and this red cloud here, and that's also positive. So I haven't been showing this chart because it's just showing pretty much what we're seeing in other charts. We didn't get any new X's, at least later in the week with the point and figure chart, but this is looking quite solid as well, as we're seeing a lot of X's as the S&P's been hitting new all-time highs. We keep an eye on the S&P 500 with the S&P 100. The S&P 100 are the biggest stocks that make up the S&P 500, and they're holding up fairly well. We saw a little bit of a lag earlier on. Now the S&P 100 is doing well and setting recent all-time highs as well. Then we look at a long-term rainbow chart. And this shows that the long-term trend continues to be positive. These are moving averages going from 50 periods all the way up to 250 periods. A long-term oscillator is called the special K, or above the line and going up, so that's positive. A weekly chart of the S&P on top and a weekly chart of the German DAX, and their correlation between the two is starting to get stronger. So sometimes we do keep an eye on Europe. If it's doing well, typically the US will be doing well and vice versa. But there are times, though, when they get out of line with each other and this relationship isn't as strong as before. Now that relationship is starting to get stronger again. Support and resistance, this is just an updated version. I'm a little off here with the upper end of this Fibonacci retracement. I haven't been showing this because once we put a top in and if we start to decline, that's when we look at these other fib retracement levels, and we're far away from those right now. The QQQs, there's other charts that I look at for the NASDAQ 100 and the Qs. This is mainly just to show that we're above all the plotted moving averages here. The blue line's above the red line, so we're still looking positive. This is the Vixen, which is the VIX measures volatility of the S&P 500. The Vixen measures the volatility of the NASDAQ 100. And we're seeing this really picking up a little bit as well lately. But I mainly focus on the VIX itself. Then we look at the S&P on top and then a ratio between the Qs, the NASDAQ 100 and the diamonds. We're seeing that they're not really going in the same direction right now, or they're more or less neutral with this ratio with the S&P 500. So there's really been no insight from this chart. The transports, which are looking a little bit better now, but pretty much have been sideways for 2024, where we have the Dow now setting new all-time highs. And the bank index or bank ETF here just coming off of setting all-time highs. As the financial sector has been quite strong. We also keep an eye on the regional banking ETF versus the financial sector. This is not really breaking out and showing any strength, but it's not breaking down either. And we're seeing an overall uptrend with this ratio. This just means that the regional banks or smaller banks are holding up for right now. Rate of change charts, I use these for information. This goes back 250 periods, and this is still looking pretty solid. So this just means the long-term trend is positive. Here's another look at that same chart. Also, we're getting above this blue line here, which sometimes can be a concern, but we can go well above that at times as well. But for right now, this is looking really positive. Keeping an eye on bonds, we look at TIPS, which are Treasury inflation protected securities, and we take a ratio of 3 to 7 year bonds. Now, when this is going up, that means there are inflation worries and interest rates are going up. When this is going down, that means that the inflation is coming down and possibly interest rates are starting to come down. What we're watching here is we're going back up with this ratio, and we're trying to figure out the context. Is inflation a problem? Well, not necessarily right now. If anything, the economy might be a little bit too strong, and the market is starting to build up some concern that the Fed won't be cutting rates like they were before. But that was pretty much last Thursday because we saw stronger than expected economic reports that come out. We don't know if that's going to continue. We're seeing this lasting a little bit longer now. So this could suggest that we're seeing a change in the overall economy where you can have interest rates going back up and you can see this ratio going up, and stocks can still go up at the same time because there's still economic growth that's happening. We look at the long-term bond ETF, which is in blue, and then the S&P 500, which is in red. The short-term, excuse me, the longer-term correlation based on 50 periods, that's starting to weaken. And we're not seeing a really strong short-term correlation as the long-term bond ETF based on price and the S&P, you can see here, they're going in opposite directions of each other currently. We look at that same thing with the QQQs to the long-term bond ETF, also having a tendency to go in opposite directions right now. Then we take the US 10-year yield on top and we subtract the German 10-year yield. And then we compare that with the US dollar index. And the dollar's been rebounding lately, even though it's still in a downtrend. But we can see that the top part and the middle part of this chart, there's a high correlation between the two as we watch the interaction of interest rates with currencies. And we keep an eye on the 2-year Treasury yield, which had been coming down. Now it's starting to go back up. But typically, when this spikes and starts to come down, that can give short to intermediate term support to the S&P. And it has been helping the S&P, but now that it's going back up, that may end up putting some pressure on the S&P. But again, we're setting all-time highs with the S&P right now. We keep an eye on the 10 to the 2-year yield curve, which is no longer inverted. We're above this blue line. We just keep an eye on this to see if for some reason it goes back to being inverted again. And we're still inverted with the 10 to the 3-month yield curve, even though it's coming back up. We still have a ways to go to get back to the uninverted state. Then I have some things called possible positive scenarios. These are just things that we look at to give us an overall direction of the and current condition of the S&P 500. These are the stocks in the S&P above their 200-day simple moving average. We're above 50 and going up. If we get above the green line, that means we're extreme. We're far away from that right now. So this chart is overall positive, but not really giving us any additional insight. Then we look at stocks above their 50-day moving average in the S&P, also above 50 and looking positive. The mid caps above 50, looking positive there. And the small caps also still hanging in there and looking positive. So thank you. I hope you found this helpful. I hope you have a really good weekend, and I will talk to you in the next video.